Hi guys, welcome to Consolidations. This video will be an introduction to group accounting and consolidations. Now, what do we mean by a group? A group consists of a parent and its subsidiaries. And a group is when you are looking at the two companies as a whole as if they were one. Now, when does a group become a group? It occurs when the parent exerts control over the subsidiary. And the definition of control is that the parent has the power to direct the activities of the subsidiary. So when such power exists, standards tell us that we must produce consolidated accounts for the parent. The subsidiary will produce their own single individual accounts, so will the parent. But then an additional set of financial statements called the consolidated accounts must be produced by that of the parent. And the objective of the consolidated statements is to show information of the activities of the group as opposed to the activities of the two single companies. So we pretend that these two companies are one. So what we need to do is to remove any transactions that occur between the two. So we are applying substance over form. The single accounts do not provide shareholders with enough information on how the group is performing. So what we do, we try to prepare the consolidated accounts in such a way that the parent shareholders can understand exactly how the group is performing. So how can the parent obtain control over the subsidiary? Well, the main one is that the parent can obtain more than 50% of the subsidiary shares. Therefore, the parent can exert control over the subsidiary. Remember, one share gives you one vote. So if the parent has more than 50% of the subsidiary shares, then that means the parent will have the deciding vote. Or if the parent does not have more than 50% of the voting shares, but then the other shareholders agree that the parent can have control, then that means that the parent's got control. If by any way the parent has the power to govern the policies of the subsidiary, that too is a way of the parent having control. If the parent can have the power to appoint or remove any directors from the board, that means they have control. And finally, if they have the power to cast majority of the votes at the board of directors meeting, the parent has control. So it doesn't matter how you get control. If you get control, the parent must produce financial statements, but the consolidated financial statements. This is an application of substance over form. The form is that you've got two different entities performing separately, whereas the substance is that these guys are a group. One has control over the other, so you must pretend that the two are one. Because since the parent has control over the subsidiary, the parent tells it what to do, and how the sub performs depends on how the parent performs, or what the parent gives guidance to the subsidiary. So let's look at other definitions. Control is the power to govern the company, but a non-controlling interest, this is the shareholding in the subsidiary that is not owned by the parent. For example, if the parent owns 60% of the shares in the subsidiary, then that means the parent has 60% controlling interest. Whereas the remaining 40%, that is the non-controlling interest. The 40% represents the other shareholders who do not have control over the subsidiary. Only the parent has control. So control exists when you've got more than 50% of the shares. But then you've got a subsidiary. An associate is a company that the parent has significant influence over. Significant influence is the power to participate in the policy-making decisions. And this is different to control because control is the power to govern the policies, whereas an associate is where you've got the power to participate in the policies. Associates will be discussed in a separate video. And then an associate exists when you've got between 20 to 50% of the voting shares. And if you've got less than 20% of the shares, then that means you've simply got a trade investment. This is where you are investing in shares, could be for long-term purposes or short-term purposes, but it doesn't really matter because these guys are not a subsidiary, nor are they an associate. And how we account for trade investments will be seen in another video. We're going to be concentrating on the parent and the subsidiary relationship. Now, like I said, the consolidated accounts must be produced as if the parent and the subsidiary are a single entity. So how are these two as one performing? With the consolidations, there are a few tricks and tips. The first thing is anything that happens between the parent and the subsidiary must be eliminated. These are known as intra-group transactions. The consolidated accounts must show only relationships that happen outside of the group. Anything that happens between the two must be eliminated. The next trick is that the parent and the subsidiary should have the same year end. Not must, but should. If the reporting dates are different, then the subsidiary will have to prepare additional financial statement to make the year end similar. And the reason why the two reporting dates should be the same is that it ensures the shareholders of the parent that they are able to understand the overall position or the performance without being the information being skewed, and they must not get confused. Another rule is that the parent and the subsidiary should have uniform accounting policies. Should, not must. So then the subsidiary statements, if they are different, must be adjusted to meet the accounting policies of the parent. And what are the exemptions from consolidations? When can the parent be excused from consolidating the parent and the sub? The reason is that the parent itself is a subsidiary, and then it has an ultimate parent, and the owners agree that the consolidated accounts are not needed. Moreover, if the parent is not a public company, then the parent need not prepare the consolidated accounts. If the parent is a subsidiary of the ultimate parent, and if the ultimate parent prepares consolidated financial statements that comply with international financial reporting standards, then the parent, the middle parent, does not need to prepare consolidated accounts. There could come a time where directors say that we may not want to consolidate the parent and the subsidiary. Examples of this would be the subsidiary is loss-making. If the subsidiary is loss-making, the directors may wish to exclude the loss-making as if not to push down the whole group's performance. This excuse is not allowed. You still must consolidate the subsidiary and the parent. Also, sometimes the subsidiary's industry may be different to that of the parent. And if the two companies operate in two different activities, it doesn't matter. The two must be consolidated still. Also, if the subsidiary is held purely for trading purposes, i.e. if the subsidiary was bought with an exclusive view to then sell on, then you don't need to consolidate. Okay? So those are exemptions from consolidations, and that is an introduction to group accounting.